Welcome to the 2021 second quarter investment update with the San Diego Foundation. I'm Brian Zimbano, Vice President, Chief Development and Stewardship Officer at the San Diego Foundation. These quarterly investment updates are an enhanced service to you, our donors, and we provide direct access to our investment leaders in a consistent, convenient, concise format so you can remain informed about the performance of your charitable assets. We will start with a brief macroeconomic update, followed by performance and attribution reports for our endowment portfolio, sustainable portfolio, and our long-term, medium-term, intermediate-term, and short-term portfolios. Leading today's update will be Kevin Hamilton and Matt Fettig. As many of you know, the San Diego Foundation recently launched our new strategic plan. One of our core pillars of the plan is delivering world-class philanthropy. And one way in which we do that is thanks to our Chief Investment Officer, Matt Fettig, and his team. Matt, over to you.
Well, welcome everybody, and thank you for joining us today. Our strategic plan is very exciting, and I can tell you that myself and all of the staff at the San Diego Foundation are excited about it. One way in which we're delivering world-class philanthropy, I believe, is by expanding our investment team. The San Diego Foundation has reached $1.3 billion in assets, and as such, we took the opportunity at the beginning of our fiscal year, July 1st, to add a full-time team member to the investment team. Her name is Eva Como, and she joined us as Manager of Investments. Just a week and a half ago, we also hired a finance and investment analyst. His name is Brandon Akins, and he'll join us to help with investment analysis. So this growing team, as we grow our asset base, and the world is obviously a complex place, having more internal resources, I believe, is going to continue our ability to generate strong risk-adjusted investment results. Brian, I'll hand it back to you.
Thanks a lot, Matt. Also joining us today is Kevin Hamilton. Kevin serves as business consultant and advisor in the investment management industry. With more than 30 years of business and investment experience, spanning both institutional and wealth management markets, Kevin has a deep understanding of the asset management business. Most recently, Kevin was managing director at Rosemont Investment Partners, where his responsibilities included portfolio construction and management, deal sourcing, and evaluating prospective investment. Since 2014, Kevin has served on the investment committee of the San Diego Foundation, and he is currently serving as the FY25 vice chair. Kevin?
Good morning, everybody, and thanks for joining us. Unless I got demoted, I think I'm still chair, Brian, but however it works is fine with me. Have you demoted me, Matt?
You are still chair of the investment committee, Kevin. Thank you.
Excellent. So we're going to get started with just a few comments on the macro environment. As most of you know, the capital markets are continuing to deliver fairly strong performance, and the S&P 500 valuation measure chart that we're providing to you right now runs through June of this year. And relative to this 25-year or so history, you can see that the valuation chart suggests that valuations continue to be elevated since the snapback last year after the quick COVID correction, or bear market, as you wish to describe it. This chart covers forward PE ratios, and it's a measure of how expensive the market is relative to what the investment world is expecting over the next 12 months. Since the market is a discounting mechanism, it makes sense to look at what you're paying today versus what you think you're going to be getting in the future. And even at that, elevations are elevated. They have come down slightly in the most recent time period. And people tend to think that means that the multiple is coming down. And how does that happen? Well, it doesn't always come down when prices come down. It also goes down when earnings go up. So to a slight extent, earnings are starting to catch up with the valuations that you see here. The other thing to point out is that our current level, it approximates what we saw back around the dot-com bubble time period around 20 years ago. We're still a little lower than that. But there are some reasons why we should be more elevated than at that period. And that is because interest rates are so much lower now. So while I would say that it's true that valuations are elevated and the equity market is a little bit extended, I wouldn't necessarily say that that implies anything in the short run in terms of significant correction or massive overvaluation. Next slide. So quick little review on employment, and I'll tell you why we're showing you this, but on the left side of this page, you see the JOLTS job openings. And job openings are currently at an all-time high, as you can see, dating back to 2000. Part of that is that workers have been somewhat reluctant to return to the workplace, given the fact that they are, receiving, let's say, income from other sources, a la the government. So while you see that job opening number as high as it is, which really looks extremely high relative to this chart, it's a little bit overstated because of that, as a greater number of workers do return to work voluntarily, you're going to see that come down. On the right-hand side, we've got a couple of things here. One of them is a chart that illustrates that small businesses are having a harder time than typical trying to fill jobs. And so right in line with the earlier comment, to some extent, it's because there aren't enough workers returning to the workplace. To another extent, it is because of the composition of job openings being different from the composition of employee skill set available. And then lastly, down below, Consumer Confidence Survey Labor Market Diffusion Index. This is just an indication that that relative to hard to find jobs, there's still an awful lot of jobs available, as I said. Next slide. So we've shown you this slide in the past, nominal and real 10-year Treasury yields. And you know well that for my entire career and then some in this business, we've been in a long-term secular decline for interest rates. And the only new thing to point out on this chart, if you look at the real yield line, which is the line below, you can see that real yields have dropped even further and are quite negative now. So real yields represent the difference between the nominal yield you see on treasuries and the anticipated inflation rate. And so the reason that you see that drop most recently is that inflation has picked up off of a very low base a year ago, thanks to COVID, but inflation has picked up, and that is making the real yield on treasuries negative. So if you're gonna lend money to the government, you are not even going to break even versus current inflation. Next slide, please. And then that leads to this chart, which I think is the most interesting of the charts we have for you today. Earnings/coupon yield on a 60/40 portfolio. So that's not super well described. Let me get into a little more detail on just the definitions around this page. The 60/40 portfolio being talked about is a portfolio composed of 60% domestic equities and 40% domestic fixed income securities on a basis. So it's a very common type of allocation for many long-term portfolios that don't have the ability to diversify into other areas. And so it's a good general benchmark for endowment type money. The earnings coupon yield represents the earnings yield of the market combined with the coupon yield on the Treasury market. And what you see is that currently that is at an all-time low. And the all-time low, if my eyes are correct, is 3.23%. So it implies that if you bought this passive 60-40 portfolio, you are going to generate, based on the earnings capability of your equity investments and the coupon or interest rate you're getting on your fixed income investments, absent any change in valuation level, you're going to get 3.23%, which certainly doesn't meet a typical endowment spending requirement, doesn't meet our spending requirement, and also is very different than the last 10 years. If you take a look at this 60-40 portfolio over the last 10 years, because interest rates declined so significantly, the return on this portfolio was pretty good. And if you didn't know much about investing and you just said, I'm going to index it to this number, you would have done okay. Very unlikely that you can do okay from this point on, however, because you can't get much lower on interest rates, and valuations on the equity market are elevated. So what is a long-term investor to do? We spend a lot of time looking at how to diversify the endowment assets of the foundation outside of these relatively simple metrics, whether it is private equity investing or certain kinds of hedge fund investing, or more recently, private credit investing, which really is private lending across a variety of different markets. Those are all ways that with the size endowment we have, we can improve the diversification of the portfolio and also improve the long run return potential so as to enable us to meet the spending requirement that we have set for ourselves. And to talk a little bit more about how we're doing on that front and what we're doing going forward, I'm going to turn it over to Matt Fettig. Thank you all very much.
Well, thanks, Kevin. And that really set me up perfectly for the next slide, which is the performance and asset allocation of our endowment portfolio. The first thing I'll mention, in line with Kevin's comments, we sometimes get questions about the pie chart you see here. And, in the old days of investing, having 60% in stocks and 40% in bonds certainly worked pretty well. The world has grown all that much more complex. And so we have all these different other sleeves within the portfolio. And the first thing I'll say is the endowment portfolio you see in front of you here is our most diversified portfolio. And that is because we have an obligation to produce a 5% spending rate for donors invested in this portfolio. But the rest of the capital is permanent capital to the San Diego Foundation. And so we know our liquidity needs from this portfolio are fairly minimal. As such, we're able to take advantage of some of the asset classes that Kevin described in the endowment portfolio, which from a liquidity standpoint may not necessarily be appropriate for some of the non-endowment portfolios that we'll speak of shortly. But starting here, you can see for the quarter up 6.4% against our policy index, which is really the portfolio benchmark, up 5.8%. I will mention the 1-year number as it is reflective of the San Diego Foundation's fiscal year end, up 31.1% versus 29.5% for the benchmark. And you can see over longer periods of time, 3, 5, 7, and 10 years, we are outperforming the policy index or our benchmark. For the last several years, we have been in the process of building out this other diversified exposure we've been talking about. Private equity and private credit sitting now at 12% of the portfolio. It has taken time to build out that exposure. And I'm happy to say that just after COVID began to ramp up, so did the performance from our private equity and credit book. And I will tell you that over the last year plus, that has been the biggest contributor to us outperforming the benchmark. It has also been the biggest contributor just to the absolute performance number you see here for the 1-year period. So very fortunate that that is working. We also have 5.5% in real estate. That is private real estate. Our target is 9%, so we have been underweight there, which has also been fortunate given some of the uncertainties around how COVID and return to work, migration out of urban areas may affect the real estate market. We also have 6.2% in what we call real assets, and these tend to be tangible assets that can perform well in an inflationary environment. So as we looked at some of Kevin's exhibits, the possibility of inflation ramping up or staying above the Fed's target of 2%, we have built in some assets to this portfolio to help protect in the event that inflation is persistent. So let's move to the next slide. This is our long-term portfolio. And if you look at the pie chart here, you see it is different. There are fewer sleeves. And one of the reasons is that this is a non-endowment portfolio. And we allow donors the ability to make grants out of their donor-advised funds pretty much at any time. So we need to maintain liquidity in this portfolio in order to meet those obligations. Also, some strong performance here. You can see we outperformed for the quarter by about 0.4%. And outperforming by 0.8% over the last year. That has helped boost the 3, 5, 7-year numbers. So doing well in this portfolio, obviously stocks were a big driver of the performance that we've had here as the market has been quite resilient in the face of this pandemic. But as Kevin described, with interest rates really falling back to zero on a short-term basis, the fixed income segment has continued to hold on and produce some relatively strong returns. On a go-forward basis, it may be harder to generate the very strong short-term results that you see here for this portfolio over, call it the next 10 years, due to some of the reasons we talked about at the beginning of the call. But suffice it to say, good performance here now, and we plan on that good performance hopefully continuing into the future. Let's go to the medium-term portfolio. So the medium-term portfolio is quite a bit different than the endowment or the long-term portfolio in that this is designed to deliver a lower level of risk to donors, which means essentially a lower rate of return over time, while also meeting that liquidity obligation we have on all of our non-endowment portfolios. Despite that, there's pretty phenomenal returns here on the page. You can see over the 1-year period, this portfolio is up close to 13%. And I'd say, the last 1 year period was really a perfect storm where the market rebounded after the initial COVID scare. So stocks were up significantly. And at the same time, interest rates plummeted, meaning the 65% of this portfolio in bonds also produced a very strong return. I think as we look out to that 7 and 10 year time horizon, that should be more in line with what we would expect over the next 10 years from this portfolio, if perhaps not a little bit less, due to the fact that stock market valuations are high, interest rates are as low as they're going to get. And as a result, it may be more difficult to generate rates of return in line with our past on a go-forward basis. So let's look now at our new intermediate term portfolio. Remember, we launched this portfolio at the beginning of 2021. And so it only has 6 months of history here. So bear with me. The portfolio is invested entirely in bonds. It was up 1.2% for the quarter. And for the first 6 months of this year, since we opened it, down slightly, down 0.6%. Remember, this portfolio was really constructed as an alternative for our short-term portfolio. We have a lot of donors that do not wish to take any investment risk with the charitable dollars they house at the San Diego Foundation. And the short-term portfolio, which has been in existence for many, many years, therefore is invested entirely in money market funds. And with short-term interest rates at zero, it's generating a 0% yield. So we were hoping to construct a portfolio made up of both short-term and intermediate-term U.S. bonds that could generate at least some positive rate of return. Now, if you recall, in the first quarter of 2021, longer-term interest rates started to move up and did so pretty significantly as fears of inflation persisted. That resulted in a loss for the first quarter, but as you can see, we made up a substantial portion of that loss here in the second quarter. So a lot more to come. This is a very short period of time to measure performance or to form any judgment, and we can talk more about this over time. The short-term portfolio, which we just spoke of, we're showing you here quarterly returns. And as you can see, this portfolio was generating about 0.3% per quarter back on March 31st of 2020. That was really at the kind of the peak of the first wave of COVID, the uncertainty, and very shortly after that, if not my recollection serves me, maybe a few days before, the Fed took interest rates to zero. And as a result, we're getting a 0% rate of return on this portfolio. There's really nothing we can do if our role is to protect the principal and not lose or see principal fluctuate to offset the fact that returns here are zero. They are highly correlated to short-term interest rates, and until short-term interest rates in the United States begin to move up, and we are not there yet, this will likely continue to deliver a 0% rate of return. So if you are interested, if you're an investor in short-term and you're interested in taking some investment risk, we would ask you to speak with your donor manager, and we'd be happy to look at the other options that we offer here at the San Diego Foundation. So last two slides for me here, these are our sustainable portfolios. Remember, about a year and a half ago, we created a sustainable endowment portfolio, and we created a sustainable non-endowment portfolio. These portfolios started with a few $1 million. You can see the sustainable endowment has gained some traction It's now up to 9.2 million in assets. Remember, we focus our investing here around the principles of ESG, which stands for environmental, social, and governance criteria. We also take the E, the environmental portion, a step further and ask our investment managers to divest from fossil fuel producers. So this portfolio has had very strong results for the quarter, very strong results for the 1 year period. And if I showed you the inception to date number, the last 1.5 years, you would also see very strong absolute and relative performance. Flip to the next page, please. And you can see the same for our non-endowment portfolio, which for now is really just a clone of the endowment portfolio. As the endowment portfolio grows, we'll be able to further diversify that into some of the assets we were talking about earlier. The non-endowment portfolio also has some room for diversification once we hit some critical mass that you can see it's now up to 9 million as well, and off to just really a stellar 1.5 year start. So in summary, really for the 1 year period ending June, I think every one of our investment portfolios was able to generate a strong absolute rate of return and outperform its policy benchmark or index, which is quite a feat in itself. The one exception being the short-term portfolio, which delivered a 0% rate of return in line with its policy index. So we're very excited about the year, but that is hindsight, and we're looking forward to continuing to structure these portfolios to deliver the types of returns you expect and you're seeing here on these slides. I'll turn it back to Brian.
Thanks, Matt. Thanks, Kevin. And thank you for joining us again today and for partnering with the San Diego Foundation, where we're leading change today for a better tomorrow. Today's presentation will be available on our website at sdfoundation.org/investments. Thanks again and have a wonderful day.